Welcome to this edition of Ethical Sustainable Investment News and Analysis to Profit By. I'm Ron Robbins, an ethical investing pioneer for over 40 years, quoted in the Wall Street Journal, MarketWatch, the Globe and Mail, and numerous other global media, and founder of the world-acclaimed ethical sustainable investing information website Investing for the Soul. And please note my disclosure statement at the end of the podcast. Now enjoy this podcast. Hello, Ron Robbins here. Welcome to my podcast, Ethical and Sustainable Investing News to Profit By, presented by Investing for the Soul, April 26th, 2019. Now, again, if any terms are unfamiliar to you, simply Google them. Also, you can find a full transcript, live links, and sometimes bonus material at my podcast page located at investingforthesoul.com/podcasts. So, here are some key items of news for the period April 12th to the 26th, 2019. The first item is titled, 3 Ways to Make Your Portfolio More Climate Aware, by John Hale at Morningstar. I really respect John. He's doing an incredible job at Morningstar in orienting that famous investment research firm towards ESG. In his latest post, he highlights the work of GMO. No, that's not genetically modified organisms, but a top-notch investment house. For decades, I've heard, and you too, I'm sure, that if you narrow your investment universe, you will get lower returns. Well, consider this from John's post. Quote, Grantham and his colleagues at GMO looked at what happens when you remove a single sector from an S&P 500 base portfolio. They created S&P 500 portfolios X energy, X healthcare, and X the other 8 sectors in the index, going back to 1989, 1957, and 1925. They found that the range of returns for the X portfolios was only 50 to 60 basis points annualized, distributed above and below the S&P 500's return. In the case of the X energy portfolio, it underperformed the S&P 500 by just 5 basis points. Annualized returns from 1925 to 1927. Underperformed by 7 basis points annualized from 1957 to 2017, and outperformed by 3 basis points annualized from 1989 to 2017. Grantham's conclusion, you can divest from oil, or about anything else, without much consequence for performance. Close quote. So, according to GMO, divest from fossil fuels and not worry about lower returns. Nonetheless, I'd be happier if this research was written up and published in an appropriate peer-reviewed journal and critiqued. Incidentally, Grantham says that the fossil fuel sector is way overpriced considering its risks. Now, do you invest in or are considering investing in municipal or local authority bonds? Have you thought about climate change risk concerning municipal bond investments? Well, you should. Bernice Napak, writing in Think Advisor under the title, How to Reduce Investment Risk from Climate Change and Other ESG Woes, writes, and I quote her, that if no counteraction is taken, such as reducing fossil fuel use, close to 60% of U.S. metro areas will lose 1% or more of gross domestic product, which will not be offset by comparable growth in other metro areas. Close quote. Think about all the risks and costs municipalities might face regarding fires, flooding events, excessive winds, etc. So before investing in municipal bonds, be satisfied concerning their climate change risks and plans. By the way, this article has a great map of the US showing those areas likely to be affected by Category 4 and 5 hurricanes between 2060 and 2080. It's quite alarming. Also, be sure to understand municipalities' long-term pension and other liability risks. Many analysts believe these alone could sink many American cities in the decades ahead. Hence, even with the tax advantages in some jurisdictions, tread carefully in municipal bond waters. If you want a good understanding as to the state of ESG data and information for investors, read the post What Investors Actually Want from Sustainability Data by Ariel C. Pincott and Julia Christensen on greenbiz.com. Needless to say, it's still a work in progress. If you've ever tried to analyze ESG information across companies, even in the same industry, it's usually impossible, as they often use different metrics. Furthermore, unless the data is independently audited and verified, it can't be relied upon. This article describes in detail how these issues might be soon overcome. Incidentally, you should subscribe to greenbiz.com. It's a great source of information for ethical and sustainable investors. Many ethical and sustainable investors shy away from the fast food industry because of the poor health and negative environmental issues they help create. Well, here's some good news in a post titled Yum Brands Shows Leadership Among Fast Food Peers, Takes Encouraging First Steps to Mitigate Its Climate Change Impacts. Quoting the post, the parent company of KFC, Taco Bell and Pizza Hut committed to pursue a science-based target to reduce greenhouse gas emissions from its operations, franchises, and supply chain, that is, Scope 1, 2, and 3 emissions, and to explore purchasing renewable energy. Sometimes, it pays well to invest in companies that are just beginning to make strides on ESG issues. Studies show that such companies often offer better alpha, that is, upside stock price potential, than established ESG winners. One new interesting ESG barometer on the horizon is a new rating service by S&P called S&P Evaluation. S&P will rate, at the request of the companies themselves, the ESG credentials pertaining to the company's ability to operate successfully in the future. You can read about it in the post Official ESG Evaluations from S&P Coming to Insurance Sector in Near Future by Don Jurgler, Insurance Journal. Quoting the post, the ratings giant on April 11th announced the rollout of its ESG evaluation, describing it as a new benchmark that provides a cross-sector relative analysis of an entity's capacity to operate successfully in the future. Close quote. Well, S&P's new evaluation ESG product sounds great. However, I see some big snags with it. First, companies request to be rated. Unlike the rating groups such as Sustainalytics and MSCI, etc., who rate companies regardless of what the companies themselves might want. Secondly, though not mentioned, S&P standard credit ratings require companies themselves to pay to be rated. Is this yet another conflict of interest, like the one that got these credit rating agencies in hot water back in 2008 and 9? Can you trust such ratings then? Thirdly, will the details of the ratings be public or just a ratings number? That's important, as it's the details that numerous ethical and sustainable investors will want to see. Now we have another survey of financial professionals showing that it's the G for governance in ESG that's really important to them. However, for many of you listening to this podcast, I'm sure that you might think the environment and/or social criteria are at least equally important. I think this just illustrates the state of ESG currently. There's still much dispute about the quantity, quality, and standardization of the E&S information in particular for it to be in the forefront for many investment professionals. The survey was reported on NASDAQ by Kurt Schacht with the title ESG in Investment Management, New Age or Just Noise. The depth of the survey is extraordinary, as 1,100 financial professionals and 23 workshops in 17 investment centers around the world took part, says the article. The survey was conducted by the elite and illustrious CFA Institute and the UN Principles for Responsible Investment, PRI. This confirms other surveys that have tried to determine the relative importance of each of the three variables that make up ESG. What this might mean for you is that when doing your own ESG research on companies and looking for maximum gains, you might want to weigh governance more highly than environmental and social factors, at least for now. Incidentally, if you're invested in wind turbine companies, beware, as there's a possible new disruptive competitor with a radically new kind of wind turbine that could be twice as efficient as present ones. This new development in wind turbine efficiency, if investors and others are unable to replicate it due to patents, etc., could mean dramatic shifts in the industry ahead. See the post? Wind power for half the price. Clarkson professor says yes. So there we have it for this podcast. Again, to get all the links or to read the transcript of this podcast and sometimes get additional information too, please go to investingforthesoul.com/podcasts and look for this edition. And remember, I'm here to help you grow in your investment success and investing in opportunities that reflect your personal values. So please don't hesitate to contact me if you have any questions about this podcast or anything else investment related. A big thank you for listening, and please click the share buttons to share this podcast with your family and friends. Come again. Bye for now. Learn how to create a simple portfolio reflecting your personal values by taking my 1-hour tutorial. Go to investingforthesoul.com/podcasts and click the link there for my do-it-yourself ethical sustainable investing pays tutorial. And don't forget to subscribe to my podcast using whatever app or site you get your podcasts from. Now, as I indicated earlier, I want to offer full disclosure. That means I'll mention in the show if I have any direct interest or holdings in companies or securities I'm talking about. Also, any favorable or unfavorable comments I make concerning companies or securities should not be considered investment recommendations. And furthermore, I cannot guarantee the accuracy or incur any responsibility or liability for any information herein. please do contact me. I love to hear from you. I'm at ronr@investingforthesoul.com. Signing off, this is Ron Robbins.